it's interesting. We talk about how this is a show that appeals to homeowners and potential homeowners, right? So today is actually really cool because I think one of the things that affects especially potential homeowners is mortgages, right? One of the things that I hear in the industry a lot is I need 20% down, right? I need this ginormous down payment to buy a house. And so what's really cool is we have Ian Ford with us today from Draper and Kramer Mortgage. And Ian is here to, what do the kids say? Spill the tea, right? Isn't that what they say? Am I cool?
Something like that.
Am I cool now that I've said? No,
Yeah.
I'm not. It's fine.
But good try, though.
Yeah, it was good, right? But Ian is here. Ian, good to see you, man. He is here to give us all of that, right? Ian, let's just jump into it, right? Do you need 20% down, 20% down payment to buy a house?
Absolutely not.
No?
And I get the question all the time.
Yeah.
As you do.
Yeah.
And I feel horrible for anyone who thinks that, what's a normal home price in Montgomery County these days? $500,000.
I mean, I don't know what's normal, but let's say sure.
There is no normal.
Yeah, right. Let's call.
Yeah, I mean, what used to be normal,
No such thing.
a year or two ago, is just not any longer.
Yeah, let's talk 500,000 just for the sake of easy numbers, right?
Right. And that could be the price of a condo in DC.
Sure.
Right. And someone trying to buy their first house, thinking I need $100,000 down payment, which is 20% of $500K.
Bananas.
Right.
Who's got 100 grand just laying around, right?
Plus closing costs,
Right.
so another $15,000.
Yep.
Right. And you've got 28-year-olds or 25-year-olds running around buying houses.
Mm-hmm.
Your peers are doing this, and you're like, what is going on?
Right.
Where's all this money coming from? And fact is that is just not the case, right? So
Right.
You can get in the house for as little as 3% down, right? 3% of $500,000 is $15,000. Much more achievable.
Right.
Add to that the fact that every state in our area, DC, Virginia, Maryland, also have home buying programs to help you cover the down payment, sometimes in full.
Oh, wow.
Right?
Really?
Yeah. So I've been able to get people in houses for under $5,000 out of pocket.
Wow.
So definitely not a 20% down requirement. I mean, it helps. It helps bring your payment lower. Is it necessary? Absolutely not.
So is there any other benefit? I mean, aside from taking a whole bunch of cash out of your pocket, right, to put towards the down payment. Of course, I'm being sarcastic there. You mentioned it helps with the payment, right? Is there any other benefit to having 20% down, or is it just simply the fact that you've reduced the amount of principal on the loan?
Yeah. So there's this, let's call it a fee called mortgage insurance that you have to pay anytime you bring less than 20% down. And it is nice to not be able to pay the mortgage insurance or not have to pay the mortgage insurance.
Yeah.
Right. That said, mortgage insurance isn't the end of the world. Right. If you've got good credit, your mortgage insurance may be, and let's say you're only putting 3% down, and there are actually a lot of factors that go into mortgage insurance, so it's hard for me to spit out numbers at you right now.
Sure.
But especially if you've got good credit, your mortgage insurance monthly payment may only be $50 or $100, right? So it's nice to not have an extra $100 payment per month, but is it like some life-changing amount of money that requires you to bring that 20% down, or you're screwed? Not really.
Right.
So let's talk about that for a half a second, right? For those that are watching that don't know, what is the purpose of mortgage insurance, right? Why is it if I only put X number of percent down, 3, 5, 10, whatever, what's the purpose of that mortgage insurance? Why do I have to have that, and why doesn't 20% down or more have to have that?
Right. It's all about safety for the lender. So the big, idea in underwriting is, all right, first off, we're going to make sure that this loan doesn't go bad and make sure that this borrower, the home buyer, is, financially stable enough to be able to afford this monthly payment.
Sure. Right.
But what if they're not? Or what if something happens and they no longer can, right? So the lender is typically going to then, foreclose whatever, and they're going to try and get the money back by selling the house. Now, lenders usually aren't the greatest real estate investors / real estate agents, right? It's a bank. They're just like, get this off our books at some point. and they're typically selling at a pretty steep discount, right? So let's say you buy your house with 3% down, right? Using that $500,000 example, you owe $485,000 on the house. Well, what if the lender then takes a 10% discount and he's selling at $450,000? Well, they're taking a big loss.
Sure.
Right? That loss is definitely mitigated by, the amount of money that you've put down, right? So if you put 20% down, the lender sells at $450,000, then, they've actually gotten all their money back, right?
So essentially the mortgage insurance is the payment for the shop, for the fee that the lender is paying, because they're basically putting their trust in you, right?
So
the homeowner.
Basically, the lender is required to take out an insurance policy on the mortgage,
Right on.
because there's a much greater chance of them losing money the more money they've lent you for the property.
Correct. And obviously, again, for the people that don't necessarily understand this whole formula and how it works, can we take a minute and explain the difference between mortgage insurance and home insurance? Because sometimes that can be confusing.
Sure.
Yeah. Sure. Home insurance insures the house, right?
Right.
So if something, classic example is a tree branch falls on the house and they need a new roof, right? Their homeowner's insurance company will pay you, Gus, to put a new roof on, right?
Yep.
That's for the house. The mortgage insurance is for the mortgage. So something goes wrong with the loan, right? The buyer stops, or the borrower of the loan stops paying, right? This insures the lender against the losses that they're likely going to be taking on.
Absolutely.
As they, wait for the payment to come in that doesn't come in over the course of months, and eventually selling the house at a pretty steep discount.
Sure.
So what I'm hearing is it's essentially an insurance policy that the borrower pays for to protect the lender from potential default by the borrower.
Yes.
Perfect.
Yeah, that makes sense.
Makes sense.
So you mentioned that we talked about if you put 20% down, you won't have that. If you put less than 20% down, you will have some level of mortgage insurance. Does it ever go away? Do you have it forever? Is this an additional? I know, and but a lot of people may not know that it's all incorporated with your mortgage payment, right? Is there a point in time where that additional part of your mortgage payment goes away, or do you have it for the duration of the loan? What about that?
Yeah, let me make a quick distinction and say that there's two ways of doing the mortgage insurance. You can do it in a monthly payment, so it'll be part of your monthly payment every month, or you can pay it one time upfront, right? So that's one way of doing it. Otherwise, let's say you take the monthly route. As your home appreciates in value, you can then ask to have that mortgage insurance taken off. Typically, and it does end up being up to the investor, but what most people do is say, okay, send an appraiser out there, and if the home appraises for that, at a point where you'd have that 20% equity,
You can get rid of it.
Exactly.
Right. And so how do you get rid of it? You have to refinance, correct?
You can either just have the lender take it off if your home's gone up in value. Refinancing is another way to do it. So
Nice.
if the home's gone up in value, and so this actually opens up another topic of discussion, right, is interest rates, right?
Right.
And typically people refinance either to take money out of the house or to lower their interest rate. And most people do it for the interest rate, right?
Right.
So we're at a particularly high point in the rate cycle, right? Rates have almost doubled over the last 6 months, right? And there's very likely, everyone buying at high points in rate cycles, when rates go back down, they all end up refinancing.
Sure.
Right.
Because, who doesn't want to save $300 or $400 on their monthly payment?
No doubt.
Right? So, as of right now, I'm recommending to all my customers that they take the monthly mortgage insurance, right? Because at some point in the next year or two, it's very likely that we're going to be refinancing to a lower rate. So you don't pay the full fee for the mortgage insurance now, because there's going to be an opportunity for us to try and have another look at that and see if we can't get rid of that, either from the appreciation in the house or by potentially paying the full fee then,
Right.
right? And getting rid of it at that point.
It's so crazy, right? There's so many different variables, right? And it's interesting how we've kind of made this kind of about mortgage insurance, right? But I think that that's something that people really should be thinking about, right? So you mentioned upfront, you mentioned monthly, right? Would some of that or should some of that be determined by, people's plans for how long they plan to stay in the house?
For sure.
Right? Like if I'm going to be in the house for, 20 years, maybe it makes sense for me to do the upfront. Whereas if I'm only going to be in the house for 5 or 6 years, maybe it makes sense for me to pay monthly because I could save money over the long run.
Exactly.
Right? Is that am I hitting that right?
The concept, absolutely. Yeah. Your plans for the home and how long you plan to be in the home will absolutely weigh into how we're going to structure your mortgage. And for example, saving the $300 a month on the refinance, if you're only going to be in the home for another year, then sometimes we don't really pursue that because you might not make your money back.
Oh, because of closing costs.
Exactly.
Right. Yeah.
Or we're going to structure a refinance with maybe a higher rate where the lender pays for all your closing costs, right? So you're not saving as much on a monthly basis, but you didn't also have the closing costs financed into your loan. Right. So you get all your money when you sell the house, right? And in the meantime, you save not as much money, but you still save some money.
Yeah.
Right? Yeah. If all that makes sense.
Yeah, absolutely. I think we should just take a quick minute and to introduce the audience to you, because we didn't really, even though you didn't need much of an introduction.
Oh, yeah, we just kind of got into it, didn't we?
We just got right into it. But I do want to touch on, because, you have so much experience in your field and in the industry. I think that's important for people to know, where you came from, how long you've been doing this, and who you're working for right now. Yeah. So if you don't mind, just take a minute, take us through your journey and how you got here today.
Ian Ford, this is your life. Right?
I've been in the mortgage industry since I was 25.
What are you, like 27? You look so young, right?
I was going to say, you look 23. What?
34.
All right.
I'm turning 35 next, 3 weeks from now.
Wow.
Got some experience there for sure.
Right.
You're an Aries.
I am.
Nice.
Why do you
so
know
am
that?
I.
Why do you know that?
Because
stuff?
I know.
Gus studies signs,
No,
Studies
I don't.
science.
I just know I'm an Aries too, and we kind of click.
We click. I get it.
What's
All
your
right,
born?
that's fair.
What's up?
When were you born?
April 8th.
Oh, okay, cool.
Yeah.
I'm the 17th.
There you go. Yeah, just a few days apart.
All right.
And a few years.
I'm in November. Is it?
Who
is it
cares?
this one? There it is.
There you go. Okay.
Sorry.
80.
81.
Oh, okay.
Yeah.
Cool.
Yeah.
Yeah, I've been doing this I'm going into my 10th year.
Nice.
I work for a company called Draper and Kramer Mortgage. And I joined because I was familiar with a couple of the people who work there. And I mean, they're some of the, how would I say it? The best or the most accomplished mortgage people I've ever been around. And I just wanted to be a part of it and, sit next to and learn from some of these people.
Yeah.
And that's been great.
Yeah.
And that's been definitely a big part of my development and my learning.
Have you been with Draper and Kramer? Is that the duration of your career? Did you start somewhere else? Or?
4 years now.
Wow.
Okay.
So I previously worked in a company that was like a national company. We specialized in refinances. And it was a great experience, but definitely not on the same level of, how I could learn and develop and grow
Sure.
as I am now.
What's the name of that? I'm just kidding. Don't do that. Just kidding.
Okay, that's great.
So
Thank you for that. That's awesome.
Thanks.
So obviously you have a lot of passions for mortgages and things like that.
Yeah. I didn't think I would when I signed up for it. But
yeah,
it's
there's definitely a good level or good amount of satisfaction that comes with that. Being a huge part of helping others become homeowners.
No
I
doubt.
mean, that's
for sure.
That's one of the biggest steps anyone can take. That's awesome.
And being able to be a part of a process that where people gain a lot of happiness.
Absolutely.
So.
And you're able to protect them from potentially dealing with a lot of dissatisfaction and potentially financial hardship as well.
I
right?
mean, everyone's
there's-
heard the stories, right?
Yeah, right,
We've all
right.
got like the friends who just had a horrible home buying experience.
Yep.
And just making sure that never happens is definitely.
Absolutely.
That's awesome.
Absolutely. So back to mortgages.
Should I do it again?
Yeah. No. obviously, I feel like, in talking to you and Dave, I feel like it's a lot easier to become homeowners than people think, or achieve that goal. So can you talk about the ease of that process? And because a lot of people kind of hold back, or they kind of put it on the back burner because they need to have certain ducks in a row before they take that step or they commit. Realistically, what are the requirements? What do they need to have in order to become homeowners?
Right. Yeah, that's a great question. I mean, really, from a technical aspect, you just have to have a little bit of money put away.
What are we talking about? Just to kind of put things in perspective.
I guess it depends on the price of the house, right?
So let's go back to that same 500,000.
3% for a down payment, but
Okay.
again, a lot of people qualify for, our house that we, our little hypothetical house was in Montgomery County.
Yeah.
The state of Maryland will give you, that $15,000 to help buy that house. So,
But real quick, I just want to put it out there, right? I mean, obviously, people should inquire with you about that, but there are restrictions to that and limitations.
you have to qualify for it,
Right,
for
right.
sure.
I mean, there's all kinds of stuff that comes.
So
along
can we
with
just talk about just a couple of those qualifications for people that are just being teased that the state of Maryland will pay that 3.5%?
You can't
They're
make
like,
too
wait
much
a minute,
money.
what?
What? Like, how do I get that kind of money?
that? Right.
Right. As 640 credit score, and you can't make too much money.
Got
Are
it.
two of the big
What's
ones.
too much? How much is too much?
I think it's like $130,000 or $150,000. Quick Google search would.
Yep.
would
And is that's based off of like
it's
the
county
family size, right? Like how
Right.
many people are in the household? I mean, there's some of the
Exactly.
different things.
Is that household income or individual?
household income?
Right on.
And it's county by county, right?
Okay.
But I'm pretty sure that in Montgomery County, for a single or two-person household, it's $131,000, almost up to around $150K for a person. Point is,
And if those numbers are not entirely accurate, we're on a podcast. Ian can help you.
Full
individually.
disclosure.
Yeah,
Yep.
yeah, right. I
yeah,
mean,
look, I mean that's and that's why I always say call me, because
Yeah.
there's
Yes.
like a million numbers that we could talk about,
Sure.
and there's, I mean it's a lot of specifics that you deal with, and it's better to just get all your information down and I figure it out.
So I just want to go on record as saying, and I know we just kind of like made light of it a little bit, but everything we're talking about numbers wise, I mean, these are all hypotheticals, right? I mean, none of these numbers should be taken,
Seriously.
I mean, you don't want to be so specific in this, right? So to that point, obviously at the end of this, we're gonna drop your contact information if anybody has specific questions or things like that. Full disclosure, reach out to the loan officer, right? Don't take what we're saying here. Take it for what it is, for the information we're trying to give, but for your specific situation, you want to talk to the man directly.
Absolutely. That's awesome. We were chatting earlier that you are licensed in multiple states. Why is that important?
Well, why is licensing important? I mean, we're dealing with hundreds of thousands of dollars of people's money, right?
Because, I mean, can I just walk into a bank and just ask for a mortgage loan and work with anybody? Can I work with a teller?
So it's a complex industry, right? There's like a lot of rules that govern how a bank can give you those hundreds of thousands of dollars, right? And we've got to have a lot of ducks in a row. Now, ideally, you as the customer never encounter any of that, right? You're getting me your pay stubs and your W-2s and your bank statements, and we're taking care of everything else, right?
Absolutely.
But, yeah, I mean, it's people who I talk to who have been top producing loan officers since the 80s, right? And are high level people in my company and in other companies, they still say, I learn something new every day.
Yeah.
There's always all these guidelines that you're dealing with.
Yeah.
Gotta be a bit of a lifelong learner there.
I love it. Which leads to my next question. So just like anything else, just like real estate, home improvement, loan officers, I'm sure there are some red flags out there in the industry, right?
Sure.
When it comes to loan officers, what are some of the red flags that people should avoid or look for?
I mean, the biggest thing that I see, and look, there's a lot out there, but the biggest thing that I see on a regular basis, right, is customer says, hey, look, I just saw this really low rate posted on my Google search or on bankrate.com.
I love that.
And it's like, yes, that is a low rate. Look, to the right of it where they say that they're charging you 2 points. on that $500,000 house, that's $10,000 in that in fees that lender is using to do what's called buying down your rate, right?
Wow.
So it's, I mean, yeah, it can be a low rate, but I would say it's artificially low because you are getting charged heavily for it. So
How do they charge for it? Do they just roll it in and to the?
yeah, so it becomes part of your closing costs.
It's 10,000 in that scenario. It's 10,000 in cash you need.
Yeah,
Right. So
Sure.
whatever your closing costs are plus 10 grand.
exactly.
So that's their fee.
Exactly.
The buy down fee essentially.
Exactly.
Right on.
And it's really easy to slide in on a refinance because they don't have to have you bring that cash.
They already have an equity.
Right.
They can cash out for.
In a refinance, we're putting all the fees in the loan, right?
Right.
So if you're not paying attention, then it's really easy to slide those fees in. So
Yeah.
I mean, I see people, oh, I got this great rate. Send me the loan estimate because I'll be able to see how they're getting to this great rate. It's rare. I mean, look, it's a competitive market. There are mortgage companies everywhere. It's rare that someone has one rate that's so much better than everyone else, right? They're usually doing something to get there.
Yeah.
So charging points is one of the biggest things that I see.
Interesting.
So it sounds to me that look, rate is important, right? But it's not. It doesn't tell the whole story,
Right.
right? I mean, there
Sure.
could be more that's going on there that people need to pay attention to and really take a good hard look at it. Make sure that your rate is actually what it is without any or with as little of the background garbage that comes along with it a lot of times.
Yeah, for sure.
Okay.
Yeah.
We touched a little bit on 3%, 5%, right? We talked a little bit about conventional loans, right? What about FHA, right? Let's talk just for a minute or so about what an FHA loan is, why it is to somebody's advantage to pursue that, what comes along with that. I know we've talked about mortgage insurance extensively, how that impacts with FHA. Give us a little bit of that because maybe there are some people that are interested in that as well.
Yeah, for sure. FHA loan, it's basically FHA stands for Federal Housing Administration. It's a government insured loan that the U.S. government essentially instituted to make homeownership more accessible to more people, right? So FHA is if you're not in, the most ideal credit situation, right? Maybe you had, late payment at some point in the past or a couple late payments, right? It's basically guidelines that will allow you to buy a house even if you have credit down into the, sometimes 500s, low 600s, right? And still have accessible home financing, right? It does come with mortgage insurance no matter what. So even if you put 20% down, you're going to pay it. Again, the strategy with that is, all right, we're using FHA right now because you need a little bit of help because of your credit situation or sometimes your income situation, right? You're allowed to borrow a little bit more and have a higher monthly payment relative to your income. But you work on your credit or you get a raise, and then what we're going to do next year is go on a refinance to a conventional loan and get rid of that mortgage insurance and save you even more money.
Nice.
So, just generally, it's more flexible home buying guidelines. And, this is where you were talking about earlier. A lot of people are surprised that they can qualify for a house. I would say that being able to qualify for a home is surprisingly easy.
Is it?
I mean, a lot of people call thinking that, oh man, I'll never get this done, but I might as well try, or I might as well ask someone.
Yeah.
And well, what do you know? Yeah, you qualify easily, right? I just worry about all the people who are saying, oh, I'll never get qualified for a home, or I doubt I'll qualify, and not bothering getting a call. Yeah, I think a lot of people would be surprised at their ability to get in a home.
So somebody's looking to buy a house, right? We don't know what type of loan they're necessarily looking for. We don't necessarily know, what style of home. We don't really know anything, right? From your perspective as a loan officer, right? Speaking about the financial side of things, what is the very first thing a prospective home buyer should do?
Let's have a conversation, right? We'll talk about some of your financials. We'll talk about your budget and see, first off, if you qualify, and then second off, what you're financially comfortable with, right? In terms of out-of-pocket costs,
right?
In terms of monthly payment. and then we could sort of put together a plan, right? And, once we've taken a look at your financials, we've got a good idea of like, all right, you want to be buying a house in the 4, 5, 6, 3, 2, whatever $100,000 range, right? You want to be buying a townhouse versus a condo, right? Given what you've told me, now right? And now you've got a very specific idea of where you want to be that you can then talk to your real estate agent about and say, hey, look, I qualify for $450,000. I'm comfortable with the payment at $450,000. What can we do?
I want to touch on something here real quick, and I know we're coming up against it time wise, right? But he mentioned making a plan, right? And I just want to put it out there. I know that there are a lot of loan officers that talk about, if you don't qualify now, let's put a plan together and let's get you from where you are to where you want to be, right? And I've seen where a lot of times that plan is, well, just hurry up and wait, right? Or throw a bunch of money at this and then hurry up and wait, right? But I just want to put it out there. I'm going to act as your hype man here for just a half a second, right? Like I have seen this in action with what you do in terms of actually creating this plan, right? There's somebody that we're working with together, and I have seen this plan, and only so much because he's got to keep a lot of stuff confidential between him and the borrower that I'm not allowed to see, right? But what he can show me, he has, and there is no doubt that it's not just talk. There is a legit plan in place to get this person from being a tenant in somebody else's house to being a homeowner. And it's really, really cool to see somebody actually put that into place where I'm so used to just a whole lot of talk. You know what I mean? It was just kudos to you, man.
Thanks.
That's awesome. On that, let's just briefly touch on the process real quick, because again, that's another thing that people, kind of fear a little bit. So, oh, it's a long process, this and that and the other, right? So take us through your approach, the process from the application or from the initial meeting until funding, I guess.
Yeah, sure. It doesn't have to be a long process, right? So there's the initial qualification and education portion, right? Which can take a few hours or a couple days, right? Depending on how quickly you can get me those pay stubs and W-2s and the documents that we discussed.
Sure.
Right. After that, I give you the thumbs up, say, hey, go find a house, right? And then David takes it from there. You go looking at houses, you make offers on houses, and then there's this process. Well, once you find a house and you and the sellers come to an agreement, what's a typical home buying process look like? Anywhere from 2 weeks to 35 days.
Yeah, I mean,
right?
I tell people on average, right? I mean, again, we're talking very generally, right? Because it's going to depend on the type of loan that they're pursuing. But I tell people that a realistic expectation is anywhere from 21 to 45 days from the time you are under contract. And that is just to make sure that Ian has enough time to get through what he needs to get through on the back end to make sure that loan is in place.
Right.
That's
So,
awesome.
Depending on how ready you are, right? If you're willing to get me your documents quickly, I'll have you pre-approved that day, right?
Wow.
If you are motivated to get a house and have a specific idea of what you want, David will get you in that house pretty quickly.
Yeah.
I've seen it happen.
Yeah.
Right? So, and then from there, we're talking about 3 to 5 weeks, right? So, I mean,
awesome.
look, I've got customers who their leases are ending in May, and today's March 28th.
Yep.
We're going to have them in the
29th.
house.
29th.
29th.
Same thing, only different.
They're going to be in their new home before the lease ends.
Wow.
For sure.
That's awesome.
So,
And I think a lot of that will, again, not to speak for you, man, but a lot of that's going to stem from that person's qualifications and any potential roadblocks and any credit issues and, employment status. I mean, all that stuff, right?
for sure.
Everything's so specific to the individual or to the family.
Absolutely.
but of course, I think, since we're hyping each other up, I mean, a big part of that is who you're working with as a lender and as a real estate agent.
100%.
For sure. Some lenders take forever to get anything done, and I think some real estate agents do as well.
I agree.
Yeah,
I
that's for
agree.
sure.
All right. On that note, is there anything else you'd like to add?
Call me.
Call you.
So that's key, right? And look,
That's
I
huge
mean,
key
this is I'm in this industry as well, so I could talk about this all day long. And so with that, I do think that there's the potential for so many questions, right? And so many different ways that somebody could take this. So if somebody wants to reach you, how do they do that?
Honestly, I am very responsive to my cell phone.
What's that number?
301-928-1507.
Cool.
Call me anytime, text,
What's
whatever.
your email? Just so we can have it.
Ian.Ford, that's IAN.FORD at DK, Daniel Kenneth, DKmortgage.com.
Like it. Okay.
Or you could just Google Ian Ford Mortgage, and that's me.
There it is.
Love it.
I like it.
Ian Ford Mortgage.
Love it. Google State University. Love it. That said, Ian, thank you so much for being with us today.
Yeah,
this
thanks,
is all
guys.
valuable information. We really appreciate it. And I hope this brought a lot of value to you, the viewers. And if you are a potential home buyer or an existing homeowner and would like to know more about financing, mortgages, and refinance, don't hesitate to reach out to Ian.
Give the man a call.
If you have any real estate needs, David Zeff and Home Improvement, myself, Gus Hamden, and we will see you on the next one.
See you soon.